You said a lot of great stuff, and it's interesting. The tax code is one thing. We can argue about how much it favors leverage, but I don't think most people would argue that it at least favors debt, which is quite odd in a world where we're all running around saying equity financing is more stable, and nobody has put on the table the idea of both for individual homeowners and for corporations about reducing the at least advantage, if not subsidy, for debt over equity. If we want less of a debt culture, we probably shouldn't be. In fact, we're changing the tax code the opposite way with dividend taxes and whatnot in the near term. So that's odd. Why short-term versus long-term? You said this. I'm just gonna say it back to you and see if you agree. It's a fascinating paradox in that making it more short-term makes the monitoring better. It makes the disaster worse when it doesn't work.
Right.
And I think a lot of regulation also has that characteristic. Less frequent disasters, not all regulators, good regulation too, but a lot of rules and a lot of things have the characteristic of making problems less frequent but more severe when they occur. And we can get into specifics, and I have some specifics, but I think there are a lot in the structure that do that. Any form, Bernie Madoff, saying the SEC will find the Bernie Madoffs reduces the frequency of Bernie Madoffs, but when you miss one, you miss Bernie. Finally, I'm going to make it even more mundane. Why do firms lever? Well, we have two levels of call option going on. And John said some of this on a call, so I'm stealing some of this from John. We have the natural call option that equities are, three levels. Equities are a call option on the assets of the firm. We have the fact that, here's another wonderful paradox, I don't know how many years ago, but introducing equity option compensation was supposed to align interest and make everything wonderful. But now executives have a literal equity option on an equity option, and then you throw in anything, and we can talk about this till we're blue in the face and probably will, but you throw in too big to fail. And your incentive to take more risk, your wealth simply goes up in risk. And I'm not saying you don't want to make a perfect probability of losing all your money. But at the margin, or more than at the margin, your incentive to take risk gets much larger from all three of those, and they're probably a toxic witches brew.
And I was just going to add to that. The other thing I think is people don't internalize the effect of leverage and aggregate, right? So people are doing this. It's related to what both Cliff and Raghu said, which is there's the incentives at the firm level to take on leverage, but that also comes from the clients that also want to take on this leverage, right? I mean, you talk to a lot of investors and you offer them a 2% return with a 1% volatility, and they say, can you crank that up to 20 and 10, right? That's really what they want.
Crank that up being a nice euphemism.
Yes, for leverage. Yes, exactly. But I think when people make those decisions, they're not thinking about, well, what's going to be the aggregate effect on the system? They don't have the incentive to think about that, and I think that's one of the things that, the fact that these things are much more connected than people thought, and not internalizing that effect on what they did.
So I want to just weigh in on a couple things. First of all, what are people going to do research on? What's going to be important? I think you just heard it. It's sort of the interaction of institutions, incentives, and markets, and trying to understand that better, because clearly there were surprises and there's still disagreement, as you hear about what caused what. And so now, we started talking about what John didn't want to talk about, what caused the crisis and what was most important. I'm going to weigh in on the opposite side of these two guys in saying that it's not clear there was this huge incentive for risk-taking at a lot of these firms, because the slope of where they played was pretty linear, meaning they had a lot of money, take Fold at Lehman or Kane at Bear Stearns, had hundreds of millions of dollars in their company, and if the bet worked, they made more. If the bet didn't work, they lost a ton, and they did end up losing a ton. You weren't at the non-linear part that they're worrying about. You were at the linear part, and they just got it wrong, and there was a confluence of all these bad things that happened. Too much money, global capital glut, too much money in mortgages because of the government. The rating agencies were bad. People thought housing prices would keep going up, and it just happened. But I, am sort of skeptical laying it on incentives, and I'll tell a story and then I'll be quiet. You can go back to 1928, and there was a partnership that got a new CEO, and he said, I have a great thing to do. We're going to build a leveraged equity fund, and we're going to put half the firm's capital into the leveraged equity fund. We're going to leverage it and sell it to our customers. They did that. A year and a half later, stock market tanked. The leveraged equity fund was worthless. Half the firm's capital was gone. This company almost went bankrupt, took 20 years to recover. Partnership. What was the company? Goldman Sachs. And they asked Walter Sachs, what'd you do? And he said nothing about incentives. He said, we wanted to conquer the world. And, you know, it just happens at certain times. Things go well. People want to conquer the world.
He didn't put that in an email,
and
though.
I don't... You know, I don't know where he was quoted as saying that. So it's a very... I mean, this is a very interesting topic. Clearly there's disagreement. And, you know, somebody's right, somebody's wrong. And that's a great source, great place to do research.
I think you make a fair point, and I'd soften my point based on yours. But I'd still say incentives matter. Because I think if you're Dick Fuld, you're only thinking a little bit about the true Armageddon scenario. You're also giving a lot of weight to the things get really lousy and the Fed will come in and bail us out. So I think that has.
But they didn't. I mean,
no, they didn't. I mean, it's a miscalculation. But I still think the element of playing with the house's money and the upside. You had your own money on the line, but I think this idea that you had more upside than downside in a federal government is more than you say and less than I first said.
Right, and I'm not sure it would be different if it were a partnership, though. I mean, that's and it was the same in 1873.
Just because it didn't happen when Goldman was a part.
There's another aspect to this, which is just to
We're down
address
here
the
now.
particular issue of Dick Fuld. I mean, how did he make his money? He made his money taking the risks and being successful over a period of time. So there's another aspect which you don't cover, which is, did he get overly confident about his ability to make money taking those risks? And there are numerous conversations which have been reported in the popular press suggesting that in fact he thought they would survive this time again for reasons that, you know, because they'd done it, they had had 9 lives before.
But he built
taking those risks.
These people, you know, the other, I don't disagree with that. I think what I'm disagreeing with is whether, you know, it was the fact that they were public or a partnership. All these same things happened when you had partnerships in the 20s. You go back to 1873 and the panic there. Huge number of partnerships did the same thing. They made leverage bets on the stock market. The railroads tanked, and a lot of people went bankrupt. So that's the.
So you think we have nostalgia bias here? There was some old time where it was all okay.
It's interesting to think about how organizational structure interacts with incentives, as well as other mechanisms for changing incentives, whether it's regulation, any of these things. But I think we all agree incentives were certainly at the core of what's going on. But
Adam asked a big question of what's the big ideas, and what I think you heard is there's plenty of big ideas in corporate finance. What's the structure of companies, how much debt, and you got the idea of incentives matter, information matters, and where we're thinking. I just want to hold down the fort a little bit that we over kind of on the investment side aren't completely out of new ideas either. So I just wanted to mention 2, I think, big new ideas that I think influence us and you and thinking about the world going ahead. One is that risk premia vary over time and across assets in ways none of us imagined before. Just as an example, let's think about the financial crisis. There's a lot of stuff that had to do with leverage and arbitrages and so forth, but there's a lot of stuff that was just a screaming buy sitting there on the sidewalk, and the average investor could have put more money into their 401k account and chose not to. Corporate bonds, you know, the spreads for corporate bonds were over the roof. You were being offered a much higher premium there than at any other time, and people were scared. And there's lots of premiums. A lot of Cliff and I have beer and argue about alpha and beta, and I think we've come to the conclusion there is no alpha, but there's 27 kinds of beta, and there's some you understand.
This is the one I want you to.
We'll get back to
this.
this.
All right, we'll get back to
But there's a
All right.
second, looking forward, the second big thing sort of on my mind on the investment side, and this is where we're going in the future, deficits, inflation. We're done with the financial crisis. We're in the middle of the sovereign debt crisis. Greece is our Bear Stearns, and Portugal and Italy are going to be our Lehman Brothers, and who knows about California. And I think there's, when you think about things fundamentally...
Germany or Goldman Sachs? Because I've seen that movie.
when you think about things on a fundamental level, I think a lot of us and a lot of people thinking about this are not prepared for the fact that large debts and deficits could lead to inflation and chaos much more quickly than many of our policymakers imagine.
And let me add something about the future of financial research. As someone who's on the investment side but does a little bit of corporate finance, I think a very fertile area, and one we don't understand very well, is how these things interact. So we've heard a lot about incentives and institutions, and we've seen in the recent crisis, if nothing else, that those things can impact financial securities and financial security prices. And understanding that interaction, I think, is something we don't understand very well. And I think that's actually it's a very broad topic, but it's a very interesting topic.
So I still feel like I don't understand should we just gird ourselves and leverage is going to be out there, there's going to be periods of deleveraging and periods of way over leveraging that'll explode, or is this something manageable? Well, getting the incentives right, making it so that people at investment banks only get their commissions 5 years after the trade or something like that, or having really high capital reserve requirements. Is this something that the government can do something about? Maybe that'll get a real
Raghu and I will probably agree on this, although I fear I shouldn't have said that maybe. But
now on principle you can't.
There clearly was, I think, a regulatory mistake in the SEC in 2004 letting the investment banks go from 15 times leverage to 30. And for some of the reasons, I think that Raghu's theory talks about when you have short-term debt and it's so leveraged, it's very dangerous. And that blew up, and that was certainly a contributing factor. You should fix that. You should, to the extent you can, and you can, in that case, have capital requirements that are more prudent. I think the other thing that doesn't seem to be on the table, but many economists think makes sense, is on the long-term debt side. Part of the problem in the crisis is when Lehman or Bear Stearns got into trouble, the claimant who you wanted to basically, stuff or take the brunt of it was long-term debt, and the only way to do that was to throw them in Chapter 11. And when you threw them in Chapter 11, which was what happened to Lehman, the system froze for a variety of institutional reasons. To the extent you can fix that, and one way you can fix that is under certain circumstances make the long-term debt convertible into equity. What you do is you let the financial institutions, they can choose their capital structure. They have a certain amount of equity. They have to have a certain amount of long-term debt that will convert into equity at some point. So there's a cost, but then they can optimize around that, and you have a system that's a lot safer than the one we had 2 years ago.
And does the government do that, or do the banks do that?
The government and the regulators do that, and there's certainly room for them to do that.
Now, Raghu, I want to hear your thoughts, but also, if you can go to Europe and have 50-to-1 leverage, does it mean anything what we do here?
So, stepping back one step from what Steve just talked about, I mean, there is a broader point that when you have such a sophisticated financial system looking for pennies everywhere, if you get any distortion in prices, the stuff can go off the rails pretty fast and go a pretty long way because it's moving at such high speed, right? And so I think one of the broader learnings from this crisis is that if prices are distorted for whatever reason, incentive reasons, government reasons, intervention reasons, whatever, a sophisticated financial system is not self-correcting because it wants to take advantage of those prices, and it sometimes tends to move off. And even the guys who try to correct it, the John Paulsons of the world, get vilified for trying to move it back on the rails. There's something about this system which is unstable, right? So where does the instability come from? Is it from the natural market forces? I tend to believe no. I think it tends to come more from the kinds of interventions that are in place. Look at, where was the crisis centered? Subprime mortgage-backed securities. Well, subprime lending is not something that banks naturally tend to do. They got into it for a variety of reasons. And so I think we need to think about those. Should the government be in housing, for example? Is it distorting the prices of housing even today? by holding up the housing market where it shouldn't be.